we are going to talk about primarily the risk-reward relationship of small caps. I think small caps is one very exciting and interesting space. We're going to, let's say we'll try to learn from Anupam. He has spent about 18 years of experience in the mutual fund industry. He's been a fund manager. He's worked with organizations like erstwhile Reliance Mutual Fund. His last organization has been Axis Mutual Fund. So now, Mr. Anupam heads the equity, side of the fund management. Okay, so welcome, Anupam.
Thank you. Good afternoon, everyone.
So we have a lot of questions lined up, especially one is from stock selection point of view or from small cap point of view or general, what is happening in the market around.
Great.
There was a time where first-time investors really used to stay away from small cap as a category. But last few years, small caps are in foray. I mean, people want to invest in small cap. And interestingly, people understand the risk involved in small
Correct.
cap. So the question is, should an investor in the early 20s should he or she consider investing in small caps? If yes, what kind of risks involved?
No, of course. See, there will always be risk. Risk is there with large cap, mid caps, and a small cap. Small caps have more risk because smaller companies are more vulnerable. If something goes wrong, the impact on them is much severe as compared to a large company because larger companies have larger balance sheets, cash reserves, etc., and better reputation in the market. So suppose tomorrow, if a 5,000 crore company goes into a difficult time and a 1 lakh crore company goes into a difficult time, the ability to borrow money for a liquidity or any crisis is much higher with 1 lakh crore company, not with 5,000 crore company. And that is why, because India in last 20 years has gone through multiple ups and downs. And that is why the impact on small caps have been much more severe. Because what we call in technical terms is their beta is very high. They go up and down. And it will continue. Rest assured, it will continue. It's not going to go away. But one very important thing in market is that as you extend your time horizon, the risk of volatility keeps on going down. So the only risk in a small cap investing is time. If you don't have time, and in my opinion, the right time, appropriate time that you should keep in your mind to invest in a small cap funds, etc., like especially, is 5 years. If you can't leave that money for 5 years, you should not be investing in a small cap. If you have 5 years, it's very good. It's an amazing thing. Next 20 years will be far superior than last 20 years. But maybe next 5 years may be bad. 3 years might be bad. 7 years might be bad because it will go through its own cycle. So if you are in 20s, 30s, 40s, up to 50s, I would say a small cap should be a reasonable part. If you are in early 20s, early 30s, a small cap and mid cap should be a very disproportionate part of your portfolio. Don't fall too much into safety net. Safety is a very, very badly perceived term, right? We imagine risk sometime. You will require some money after 3 years, after 5 years. Keep it maybe in less risky product like flexi cap or multi cap. Don't put all into a small cap. But significant part should be invested and leave it for 10, 12, 15, 20 years. So yes, you have to invest in a small cap.
Small cap. Yeah, no, actually that makes sense. When somebody has a longer horizon, I think. But interestingly, what has happened is, you did mention this word, that they go through cycles.
Yeah.
2021 was excellent for small cap, and then last couple of months have not been that great. What's your outlook for the next, I would say, a year or so, or 2 years or so, considering the current valuations? Where do you think small caps are positioned? Is this the right time for me to enter in a market condition like this now?
If you're doing SIP, it's good. Don't do lump sum, in my opinion, in small cap right now. For lump sum, it is not a good time. See, there is a fundamental change that is happening in India as far as small caps are concerned. There are 3 things, very, very important things that are changing for small caps. The first and foremost is access to talent. And I'm saying it from small cap companies, because the company has to grow for you to make money out of small caps. The second is access to capital. And the third is access to newer markets. Right? These three things are dramatically changing. The success and failure of a company depends on the people working in it. In last 5, 7, 10 years, two things have changed in this whole talent market. One, there is a large pool of trained talent, experienced talent that is willing to come out of larger companies because they are feeling confident, safe, and work in smaller companies because they feel it would be more challenging, more rewarding. So smaller companies are getting very good talent who has been trained in best of the companies in India. Number two, even the newer fresh blood is willing to experiment and work in smaller companies. Earlier, which was not there. The companies have also changed. Earlier, most of the small companies, what we call is Lalaji ki dukan. You know, the owner decides the culture and he treats everybody like Munimji. You do this, you do that, and people don't like it. Like they want to work freely, think and deliver, etc. That has changed. Promoters have changed dramatically. Especially if you see last 10, 15 years, lot of people who are establishing new companies or who are running these companies, they are very well educated and first generation entrepreneurs. They are not traditionally from family backgrounds. So they are establishing a very good culture. People don't realize it that this qualitative factor is going to be the most important factor for success of smaller companies. It is not about financial opportunity, India growing. See, there are 800 crore people in the world. Global GDP is $100 trillion. So there is no dearth of opportunity for anyone. In India, there are 150 crore people. GDP is $3 trillion. There is no dearth of opportunity. But how you capture that opportunity matters. And you capture it by having good talent. That is the most important basic requirement. So that is changing for small caps. And that is the biggest, I would say, threshold that will drive the future growth for a small cap. The second thing is access to capital. See, 20 years ago, it was very difficult for smaller companies to get capital, both debt and equity, because most of the entrepreneurs don't have assets, or they have very limited asset, real estate, etc., that they don't want to risk. They can't get debt because there is no security available. Traditional banking system is not lending them. So they have a very limited ability to grow. So they are in a trap. Now, in last 10 years, every big name in private equity business in the world is available in India. Almost 30-35 private equity funds who are globally very large, who are managing more than $100-200 billion of assets, are present in India and providing capital. If you start counting, at least in Chennai, there would be more than 200 companies funded by private equity. So they are getting equity capital, risk capital. And secondly, even from a banking perspective, things are changing. Private banks are taking that risk of unsecured lending, etc., at bottom of the pyramid level, and that is driving growth. So this access to capital problem is completely solved. And in last 3 years, IPO market has been very, very benevolent to smaller companies. You know, if you provide capital, if you have right promoter, etc., people are willing to give capital to him. If he is growing it, creating wealth for you. So that has dramatically changed. So that is second thing is access to capital. And the third thing is access to market. Suppose 30 years ago, 20 years ago, some big company comes to India and says, I want to buy $500 million worth of goods. What happens? He lands in some place, let's say Bombay. He has to go to Gujarat. Ahmedabad 20 years ago was not an international airport. So he has to land in Bombay. Bombay he comes out, sees the traffic, not good quality roads. He drives to Ahmedabad, bad roads, huge traffic. Then he asks them how you will supply. If you 25 years ago, if you had gone to any industrial development area, corporation area, or what we call this industrial area in India, they had pathetic roads. No guarantee of electricity. Yeah. So he would say, boss, you are very good. As a company, you are very good, your quality is very good, but I have no damn confidence on supply chain.
The ecosystem.
The ecosystem. So I will not give you this order. So that whole thing has changed. The reputation by IT, by pharma industry of Indians being very, very good in terms of delivery, etc. Government has spent so much money on infrastructure that the thought process is changing.
But the challenge further what gets added is the fund I have invested may or may not be in the top quartile or the one of the best performers.
Correct.
How long should I give it to the fund to perform? And what should I do if it is not doing well for a certain period of time?
Okay. See, for any kind of category, the time horizon may change, but for small caps, what you need to do is, so to filter it basis return is not a very bad idea to begin with. It's not the worst idea. It's not that you should not do it. Of course, you should do it, but look at longer term performance. Don't look at 1 year performance. Maybe look at 3-5 year performance, right? Then ask why this fund has done well. It's a very important question to ask, especially in small caps, because small cap funds are very, very different.
Okay.
Not two small cap fund managers are same.
Okay.
Their thought process, their risk-taking ability, their holding ability, their way of constructing portfolio is very, very different. Because these are very index-agnostic portfolios. And small cap is the real investing in India. So what you need to do is, you select fund, first look at the philosophical approach and maybe some return criteria over at least, let's say, 3 to 5 years. Don't look at 1 year return. 1 year return is very, very misleading because it could be just because of market sentiments, right? Then after that, if funds are not doing well, give it some time and ask question, because every mutual fund does con calls. They spend time in explaining to investor what they are doing. If it doesn't come back in, let's say, 24 to 36 months, or maybe you can take a time horizon of 12 to 24 months, then decide to churn it. Okay. Don't churn it very soon. Okay. Because as Bala was saying, the moment you sell it, it will start doing well.
Yeah, it will start doing well. Mostly it happens, be it for mutual funds or for stocks also.
Yeah.
So, now slightly moving away from small cap space, talking about some of the generic wealth creation or investment decisions point of view. We have covered for somebody in early 20s. Say somebody who is in 30s, now has a family responsibilities, and you also have some serious financial goals. So now is when you start thinking about retirement, buying a house and multiple other goals. What kind of equity allocation that person should have? Somebody who is in 30s with family responsibilities and so on.
See, I might sound extreme, but I will tell you my thing. My rule is, till the time I hit 60, except my provident fund, 100% of my money into equities.
Okay.
100%. There is no debt allocation. There is no real estate. I have only one house where I live. Okay. And I have only like yearly allocation to gold for my wife as a gift. Okay. There is no gold investment. It's all expenditure.
Expenditure, yeah.
Yeah, because you pay so
it's
much
your personal asset,
markup, right?
Yeah,
25% markup on gold. Correct. It's killing me. But 100% of my allocation into equity. Yeah. See, up to 50, 55, there is absolutely no, if you have provident fund, and if you are in a job or in a business where you don't have provident fund, then 10 to 15% of your allocation, because provident fund is basically 12%, right? Yeah. And 12% from employer. So 24%. So up to 15%, if you want to go extreme, much more safety, 20%, you can go into debt. But otherwise, you should be 100% in equity. There is absolutely nothing else that will beat equity next 20 years in India. And that I'm damn confident. Forget small cap, even large caps will beat everything else. Let's say a well-managed flexi cap fund, a multi-cap fund will 100% beat any other asset class in India. See, there is no problem per se that we are going to collapse. This country will never collapse. And that's the biggest problem, that people perceive that this country will collapse. This country will never collapse. Next 100 years, we will not collapse. And why? Because we have survived the most difficult phase of our journey as a country of last 75 years. These were the most difficult times. When this country became independent, nobody ever believed that this country will survive as a nation. In short term, you make money from sentiments, 1 year, 2 year, or what we call is re-rating, right? Stocks get re-rated. In medium term, you make money out of capex cycle, capacity building. In long run, you make money only because of two factors: quality of people, quality of institution. There is no other factor. If you have good quality people, if you have good quality institutions, 100% guarantees that you will make money. There is no way that you will not make money, right? So we have crossed that hurdle. So don't worry about safety. This country is not going to collapse. Invest in equities. Have that confidence. If you don't have confidence, look at your own history. what happened in last 20 years and then what can happen in next 20 years.
Well, it's a very great, like reassurance for someone who says that, okay, markets are very volatile, geopolitical risk is happening, then we don't know what would happen to us. I think in that way, I think these words are very assuring. So then when we get to the next debate, we are talking about equity, you're saying almost 80 to 100% allocation to equity.
Yep.
For someone with a 20, 30 years kind of an investment horizon,
Correct.
or for that matter, even 10, 15 years. But there's always another asset class which tends to pose a competition to equities, real estate. Suppose if I'm looking at buying a house worth 1 crore, or there is also these days many arguments which come in, don't invest in a house, you stay in a rented house, you invest the same in equity. Where do you stand on it? Real estate versus equity. Should we be buying a house? Should we be investing in real estate?
See, you should buy one house. It looks good. It looks fine. You can do whatever you want. Landlord cannot force you to do something.
Yeah.
But beyond that, I think unless and until you are damn sure that you are getting a very good deal. See, the problem with real estate is that it is all anecdotal. There is no data. And I have done this exercise multiple times, that I select randomly 10, 15 people in my office or in my acquaintance, and I ask them, those who do real estate investing, calculate your return. Imagine whatever price is quoting for your house is correct. It is never correct.
It's never correct. Yeah.
You go and try to buy the same house, you will get a different quote. You go and try to sell the same house, you will get a different quote. Right? Real estate prices are absolutely meaningless. And nobody has been able to calculate the correct IRR, correct return. See, 90% of the people make less than 5-6% in real estate. 90% of the people. This is not exact data, but this is something that I have experienced by looking at my own research and etc.
6% annualized CAGR.
Annualized kind of thing. And for this return, you are buying a heavily illiquid asset. Highly illiquid asset. You can't sell and you can't compound most of the time, because generally what happens is real estate gives you return in geographical spurts. Sometime this area will give return, then this area will give return, then that area will give return. And that looks to us very promising, right? Yeah. Something there has given 20%, so this will also give us 20%. But that doesn't happen. So from that perspective, it's not a very, very good investment idea. The only benefit you get, you can leverage, which you should never do in equity. You should never ever leverage in equity. If you incorporate cost of inflation, cost of leverage, and the cost of liquidity, actually real estate theoretically is not a very exciting investment.
Fantastic.
Thank you.
Thank you very much, Anupam, for that lesson. Thanks. Thank you.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing. Please read the risk disclosure documents carefully before investing in equity shares, derivatives, mutual fund, and or other instruments traded on the stock exchanges.